There's an old saying that says stocks go up on escalators and then plummet on elevators. Now, to better understand how the stock market has responded to elevator rides, I want to consider the worst performing quarters for the S&P 500, and we're going to look at a window of 1940 to 2017. You see, the average loss during those worst quarters was just over 20%, and I get it. That is a brutal move in just 3 months, but the subsequent 1, 3, and 5-year returns, quite frankly, they're staggering. It's almost like that index was placed in a slingshot, pulled back, and released to fly. And given that the drivers of each of the downturn were presumably different, the index's consistent recovery is even more remarkable. So let's consider this not so hypothetical scenario to better understand why this pattern keeps on happening time and time again. You see, volatility begins to rise for whatever reason and catches the eyes of nervous investors. And the media, they begin to run stories of large one-day losses and how they compare to history. For example, the Dow Jones Industrial Index, it fell 1,175 points on Monday, February 5th of 2018. Now, at that time in history, it was the largest point decline ever, which led to headlines like Dow plunges 1175, the biggest point drop in history. That's from NPR. Or the BBC said, U.S. stock plunge sparks global sell-off. Here's the thing. Comparing point decline in an index, it provides zero insight. Only the percentage move really matters. See, the Dow closed the prior trading date at 25,520. So a drop of 1175 points, it was about 4.6% decline. Now, while that day is not fun, it was not even close to the largest daily percentage loss in history. But the media, they don't care. You see, these headlines, they get people to click on links, and that sells advertising, right? And market timers and the most skittish investors, they begin to sell early, which only adds more fuel to that fire. And then stories that counter this narrative, they get pushed all the way back to the last page, oftentimes below the obituaries. This is when economic data and other fundamental drivers, they're no longer front page material. And the stock market decline, it accelerates to the point where it begins to flirt with a correction. Now, as we talked about last week, that's a decline of 10% from a peak. Now, this gives the media, quite frankly, the green light to run stories of a looming recession, and they begin to invite those fear mongers to primetime shows to prophesy the end of the financial world as we know it. Now, let's face it, as investors sitting at home, oftentimes we begin to panic. Is this the next 2008? Nobody saw that coming, so why is this time any different? And after a few weeks of sleep deprivation, the fear and the panic, they can become too much. And oftentimes you call your financial advisor and beg them to make the pain go away. And as you breathe a sigh of relief after those volatile stocks in your portfolio get replaced with perceived safety of cash or maybe money markets, guess who's sitting on the other side of that trade with a ear-to-ear grin buying what you're wanting to sell? It's the Wall Street money machine. You see, that's when professional investors become the most charitable selves in these times. If you can't take that misery of owning stocks that are down over 20% in a matter of weeks, well, guess what? They're always here to help with their hand out. And they gladly take that off your hands. And in the process, they convert your short-term pain and losses into long-term misery and losses. And because that volatility eventually does die down, well, what happens? Panic sellers, they exit the market and stocks stabilize, which prompts the media to really quickly shift the narrative, and they start to publish stories of recovery and buying opportunity as economic data makes its way back to the front page. Now, sellers, they're often left just to kick themselves for acting so rash. And some may never return to the stock market because the scars just run too deep. So ultimately, what's the bottom line here? Well, I want to give you a pro tip to differentiate between panic and the start of a recession. You see, stocks are fueled by economic growth over the long run. And the U.S. economy, it is a massive machine. The fundamentals driving it can change slowly and can often be observed. I want you to think about an oil tanker. Course correction for a ship longer than a football field, it takes a while to complete. And the trained eye, can often see where it is headed by checking its wake, the propeller speed, and things like that. Now, the US economy is that oil tanker. And when the stock market is moving around like a speedboat, professional investors, well, they take notice because something other than fundamentals is usually driving prices. Quite frankly, more often than not, emotions are what decouple the stock market from the economy. But the pros know that emotions almost never derail $22 trillion economies, so they step up, they buy up what they can, and then patiently wait for stocks to go back to being fueled by the fundamentals. So the bottom line is that blood in the water, well, it attracts sharks. And the next time fear and panic get the best of you, I want you to ask yourself why buyers are so willing to help. When you sell, somebody's buying. What might they know that you don't? And could that be a sign that cooler heads could prevail? If you have questions, or if you have anything else that you would like to ask of our team, just give us a call with those additional questions.